What if I told you that the very thing you've been avoiding could be the key to unlocking your financial freedom? We often hear the word debt and immediately think of stress, sleepless nights, and a life weighed down by financial burdens. But what if the real issue isn't the debt itself, but rather how we understand and manage it? This video is about to challenge everything you think you know about debt and show you how it can either be your worst enemy or your greatest ally. Are you ready to learn how to turn debt from a four-letter word into a powerful tool for building wealth? When it comes to debt, there's no denying the fear and anxiety that often surrounds it. But debt in itself is not inherently bad. In fact, it can be quite the opposite. The key lies in understanding the different types of debt and how to manage them effectively. You see, not all debt is created equal. Some debts can drag you down, leading to financial ruin, while others can be leveraged to improve your financial standing. This distinction is crucial if you want to take control of your financial future. Let's begin by talking about the two main types of debt: good debt and bad debt. Good debt is like an investment. It's money you borrow with the expectation that it will help you generate more income or increase your net worth in the long run. For instance, taking out a mortgage to buy a home can be considered good debt because real estate often appreciates in value over time. Similarly, borrowing money to invest in your education can also be seen as good debt, as it has the potential to increase your earning power. On the other hand, bad debt is what you need to be cautious of. This type of debt typically involves borrowing money to purchase depreciating assets or to fund a lifestyle you can't actually afford. Credit card debt, especially when used for non-essential items like luxury goods or vacations, is a prime example of bad debt. This kind of debt can quickly spiral out of control due to high interest rates, leading to a cycle of financial instability. Now that you understand the difference between good and bad debt, the next step is to manage your debt wisely. One of the most effective strategies is the 30% rule. This rule suggests that you should never spend more than 30% of your monthly income on debt payments. By keeping your debt within this limit, you can ensure that you have enough disposable income left over to cover your living expenses and save for the future. This simple yet powerful rule can prevent you from becoming overwhelmed by debt and help you maintain a healthy balance between borrowing and saving. Another important concept to consider is opportunity cost. In the context of debt, opportunity cost refers to the potential benefits you give up when you choose one financial option over another. For example, if you use a significant portion of your income to pay off a low-interest mortgage early, you might miss out on the opportunity to invest that money elsewhere, where it could potentially earn a higher return. By understanding and weighing the opportunity costs of your financial decisions, you can make smarter choices that maximize your wealth over time. But managing debt isn't just about limiting how much you borrow or being strategic about your financial choices. It's also about diversification. Just as with investments, diversification in your debt can be a smart move. Instead of putting all your eggs in one basket, consider spreading your debt across different types of credit, such as a mortgage, a student loan, and a business loan. This way, if one area of your financial life takes a hit, you won't be completely wiped out. Diversified debt can provide you with a safety net, allowing you to manage risk while still taking advantage of opportunities for growth. In addition to managing your debt, tax optimization is another crucial aspect of financial planning. Taxes can eat away at your income, but with the right strategies, you can minimize your tax liability and keep more of your hard-earned money. For instance, certain types of debt, like mortgage interest or student loan interest, may be tax deductible. By understanding the tax implications of your debt, you can make informed decisions that reduce your tax burden and boost your overall financial health. Taking control of your tax situation is not just about reducing what you owe to the government. It's about optimizing your entire financial picture. This means planning ahead, keeping detailed records, and consulting with a tax professional if necessary. By being proactive about your taxes, you can avoid surprises at tax time and ensure that you're not paying more than you need to. So, what's the takeaway from all of this? Debt doesn't have to be a dirty word. In fact, when managed correctly, it can be a powerful tool for building wealth and achieving financial freedom. The key is to understand the different types of debt, distinguish between good and bad debt, and utilize debt responsibly. By following the 30% rule, considering opportunity costs, diversifying your debt, and optimizing your taxes, you can take control of your financial future and turn debt into an ally rather than an adversary. Remember, financial success isn't just about how much money you make, it's about how wisely you manage it. And that includes understanding and leveraging debt. So the next time you find yourself faced with a decision about whether or not to take on debt, don't just think about the short-term implications. Consider how that debt can be used strategically to enhance your long-term financial goals. With the right approach, debt can be the key that unlocks a world of opportunities. Now, let me ask you this. What will you do differently the next time you're faced with a financial decision involving debt? The answer might just change your life. If you really learned something about your financial freedom, then let us know in the comment section. Also subscribe to our channel, Elite Finance Insights. Thanks for watching the video. Goodbye.